Vamos a analizar también este dato de IPC con nuestro próximo invitado. Saludamos a Jay Pelosky, founder and principal of TPW Advisory. Jay, good afternoon. Thank you so much for attending us.
Hi, Raquel. Nice to speak with you.
So this is the day's data. The US CPI has soared to 8.5% in March. It's the highest level since 1981. Even the White House itself had warned about an extraordinary high inflation. What are the main components of this inflation and how high could it rise?
Well, I think that's a very interesting question, Raquel, because we're in the early stages of a switch from goods producing inflation to service inflation. And so importantly, you mentioned the headline number of 8.5%, but the core inflation number actually came in below consensus at 0.3% month over month versus an expected 0.5%. And that was in large part because used car prices, which have soared over the last year, were down about 4% last month in March. It's actually the biggest monthly decline in about 50 years for used car prices in the United States. But on the other side of things, gasoline prices were up 18% month over month, and airline prices were up about 11% month over month. So you see that switch away from the COVID-inspired demand for goods like cars, like houses, etc., and moving towards service activities like flying, going on vacation, traveling, etc. And I think that's really where we're moving to. So I believe that this month will mark the peak in U.S. inflation. And we should expect a fairly significant decline in inflation prints over the next several months.
We are witnessing a skyrocketing bond yields as well. Jay, the Federal Reserve is already behind the curve, and a surprise is not ruled out at the next meeting in May. Could the Fed raise interest rates by 1% or instead of 0.5%?
I hope not. I think you're right. The consensus is that the Fed is behind the curve. But I also think, and I wrote about this in my musings on Friday, that we're kind of been in a fever, like an inflation fever, where we keep having higher inflation prints. The market keeps pushing interest rates higher, keeps pricing in more and more Fed rate hikes. So now at a point where basically the market has priced in 11 25 basis point hikes over the rest of this year. And since we only have 6 meetings this year left, that suggests that several of those hikes will have to be at least 50 basis points, if not more. But as I said, I think we're at the peak of this fever. And so while I do expect the next Fed hike, which will be in May, there's no meeting this month. So the next meeting is in May. It will be most likely a 50 basis point hike. But I think after that, if I'm correct in expecting inflation to come down pretty significantly, then I think the pressure on the Fed to hike 50 basis points in June and beyond will also be reduced, as will bond yields. I think when we saw the reaction today, right, a week ago, 2 weeks ago, the 2-year, 10-year yield curve was inverted, right? Today, after the announcement of the CPI, the spread between the 2-year and 10-year is almost 30 basis points. So we've completely undone the inversion, and we're now back to somewhat of a more normal yield curve. And you see that reaction with stocks doing better. Stocks like to see a steep yield curve. So my expectation is that rates have room to rally here. We've had a huge move, a historical move in interest rates the last couple months. There's room for a rally. And then as the year progresses, I think we see rates backing up again at the long end as the economy is shown to have more resilience and is growing better than people expect.
Okay, so rates have a room to rally, but just 50 basis points, Jace. Changing the subject, this week kicks off the US earnings season with the banks, where we will gauge the economic outlook and also the impact of this inflation that we are talking about. What are your expectations?
No, I think, again, you're right on the money with your question. We are beginning season, and I think markets and investors are very interested in seeing how companies have maneuvered through this very volatile period. And I think I'm expecting better earnings than consensus. It's important to note that consensus earnings for Q1 are 4% below the actual earnings in Q4 for the S&P, and that's quite unusual. Usually quarter over quarter, the market expects an increase. It's actually only the sixth time in the last, I think, 35 years that we've had quarter over quarter expected decline in earnings growth. And so I expect actually that earnings will do better than that because let's remember, we are in a pretty high nominal growth environment, right? Nominal growth meaning real plus inflation. It's probably a nominal growth environment of around 6 to 8% in the US and similarly in Europe. And so earnings are also in nominal dollars, right? And so the idea that we're only going to grow earnings 3 or 4% with nominal growth of 6 to 8%, I think that's quite a low bar to beat. And so my expectation is that markets are going to like the earnings season this year, this quarter, not only in the US, but also in Europe.
These results can work as an impulse to the market. Can a good season end with negative sentiment in the markets?
Well, the sentiment is really quite negative now. It's you can pick your indicator, but most sentiment readings are about as negative as they get. And so I would actually think that over the next couple of months, I think there's room for a couple of things to happen. One is peak inflation. That should be good for markets. Two is better than expected earnings. That should likewise be good for markets. Three is an expected policy stimulus out of China, which should also be quite good for markets. And four, potentially, would be a ceasefire in the Ukraine, which would clearly be very good for markets as well. So I actually think that the markets over the last couple of months have had to discount an awful lot, conflict, spiking energy prices, rising food prices, a lot of uncertainty, and that's now in the price. And so going forward, I think you could argue that there are many things, I just gave you four, many reasons why one could think that risk assets like equities could do better over the next couple of months rather than continuing to be weak. And that's our outlook.
You have mentioned China. How do you see the lockdowns today in China, in cities as Shanghai or Shenzhen, and their impact on the world economy, especially in the bottlenecks?
Yes, that's a really key question. I mean, the market, we've had to deal with so many things over the last couple of years kind of coming out of left field, and the big lockdowns in Shanghai and in other cities in China is just yet another example. Whereas here in the US, I'm in New York, I know you're in Madrid, in the US and Europe, COVID is basically ebbing. It's becoming less of a day-to-day issue. In China, it's become a huge issue, and so you're locking down one of the biggest cities in the world. I do think, though, that China has more expertise in these kind of bubble situations where they put a bubble around key areas, key production areas, key ports, etc., and allow them to continue to function, albeit maybe not at 100%, but still function. And so my view in China, we like China assets. We're overweight Chinese equity in our model portfolios as well as China debt. Chinese debt has been about the best performing sovereign debt in the world this year to date. So that's worked out well. The equities have been more challenged, but I do expect, as I said, a significant policy response coming from China. They have plenty of room to ease interest rates. Inflation's only 1.5%. They have room for fiscal stimulus. They haven't really used fiscal stimulus over the last couple of years. And let's remember, President Xi is looking for his third term this fall. And so I do expect a pretty meaningful policy response out of China after last month, roughly a month ago, when they came out and verbally intervened and supported the markets. Once they saw what uninvestable has meant for Russian assets, they quickly decided we don't want to be termed uninvestable. And so they verbally supported the markets. Now we're in the action stage, and I expect that particularly monetary policy to support risk assets in China over the coming months.
But do you see this situation in China could add more inflation to the global economy, given these bottlenecks and the supply chains problems?
Well, I think it's that's a concern, but it's offset by the ebbing of COVID in the U.S. and in Europe, which should help unsnarl those supply chains and allow people to go back to work, which then reduces the pressure on wages. And really the risk for inflation is that you have wage-driven inflation, which kind of gets into the system and is much more difficult to dampen down. The Atlanta Fed, as an example, has a sticky inflation indicator and a flexible inflation indicator. The sticky inflation is running at about 4.5% year over year. The flexible inflation indicator is running at 18% year over year. So clearly that 18% is unsustainable. And that's what I think, as COVID ebbs, as supply chains unsnarl, as people go back to work, that's what I expect to see come down and support lower inflation. And I do expect, my understanding is that the ports in China are still working. They're just not working at 100%. And I would expect that situation, as soon as it can be resolved, I imagine it will be resolved, and ports and production will get back unsnarled. But as I said, this is just, the third or fourth or fifth issue that investors have had to deal with over the last couple of years, from COVID to climate to conflict to COVID again. There's a lot on people's plates, but that's why when you look around the world, valuation for equities, whether it's Europe or China, they're at 15 or 20-year lows on valuation. So an awful lot is in the price, particularly outside the U.S. The U.S. is still quite expensive on a relative basis, but stocks in Europe and in Asia, Japan, China, etc., are very cheap on a historical basis.
Jay Pelosky, thank you so much for attending us. Have a nice day.
Thank you. You too.